Hello everyone, welcome to today's US Open. I'm your host, Nikos Zabouras, Senior Market Specialist at FXCM. It is Tuesday, August 8th, 10 minutes before Wall Street opens. We have another packed session today. We already had China's trade data out today, which disappointed once again and actually sent oil prices lower. And there is also broader risk aversion from other little things, such as Moody's downgrading a series of US banks and Italy imposing a windfall tax on local lenders in the country. And of course, there's also caution ahead of the US CPI inflation report, which is due on Thursday. Now, other than that, Friday's NFPs had something for everyone, doing little to dispel monetary policy uncertainty. And that, again, creates some caution in Wall Street and weighs on NASDAQ, along with Apple's stock slump after disappointing results, that both of those from last week, but filter through to the current one. Now, that's pretty much the main themes for today's webinar. But before we begin, as always, please read carefully through the risk warnings and the disclaimers. Once again, please read carefully through the risk warnings and the disclaimers before we begin, and bear in mind that anything discussed here does not constitute investment advice and should not be construed as such. Okay, let's get the ball rolling. We have quite a few things to talk about, as I have already mentioned. Let's start with Euro USD, as we typically do. Then we will go to US oil. We're gonna follow with Apple's stock, and then to the NAS 100 before we round things off with what's ahead. So Euro USD benefited on Friday since job growth surprised to the downside again, in further signs of cooling in the labor market. However, unemployment dropped one more time and wages remained elevated, while Governor Bauman spoke of the need for additional rate increases over the weekend. As such, it remains in this weak phase after ECB President Lagarde opened the door to a September pause, and there is scope for further losses towards the 200 days EMA, which is located at around 1.08, although bigger decline that would challenge 1.0634 would need a strong catalyst. Despite this weakness, we're already seeing some effort to contain it, and a recovery effort would not be surprising, but the common currency does not inspire confidence for a return to the 1.1276 resistance. Of course, the pair's trajectory will be determined by the US CPI inflation on Thursday, and we're going to talk about that a little bit at the end of our session. Now let's move over to US oil. Here we are. The commodity comes from 6 straight profitable weeks in the best run in over a year. The oil market is widely expected to tighten in this second half of the year, helped by the massive OPEC plus output cuts, and Russia and Saudi Arabia actually said that they were roll over their voluntary cuts into September as well. However, China data continue to disappoint, and today's release of the trade export and imports plunged to the lowest level since early 2020 and the height of the pandemic, the COVID breakout. We had warned of a drop, and after failing to set new 2023 highs, the oil prices slide today due to China and the broader risk aversion ahead of looming US and Chinese data, because we expect CPI from China and the US. It is now vulnerable to the 200-period EMA at around $77, and daily close below could pose the upside momentum, but we're cautious around that and further losses towards the daily Ichimoku cloud. Despite today's weakness, as we said, it's hard to see sustained losses given the production cut, but on the other hand, and prospects for a tighter market, but on the other hand, China fears over China's recovery, the world's second largest consumer of oil, could contain the upside. At this stage, bulls are clearly in control and can try again for new 2023 highs located at 83.55. But we're not so sure about a bigger rally that would tackle 90.36, the next resistance. And now let's go over to Apple, because we had last week the quarterly results for Q3 of fiscal year 2023. Here we are. Overall revenues dropped more than 1% in that fiscal quarter to nearly $82 billion, and the lowest levels in almost 2 years. And guidance of similar year-over-year performance in the current quarter disappointed. iPads, Macs, and iPhone sales dropped. CEO spoke of AI initiatives, but so far it looks like Apple is sort of in the background on this AI arms race, and that could prove problematic down the road, because even if it does progress, if you're first and if you're fast matters. The bright spot of the report was the increasingly important service segment, which includes a streaming service, Apple TV Plus and Apple Music, among other things. And robust iPhone sales in emerging markets were also another silver lining. Now, Apple had rallied around 50% in the January-July period, hitting new record highs, and this had created concern around the stock's valuation, and the poor results aggravated these fears, sending AAPL.US to its worst day of the year on Friday after those results, and extended losses at the start of this week. You can see it right here, and actually closed below 23.6% Fibonacci. Now, this creates risk for further losses towards the critical confluence of supports in the 170-168 region. On the other hand, of course, daily close below that would shift bias on the downside. On the other hand, the RSI on the bottom of the chart points to overbought conditions, to oversold conditions, and the aforementioned confluence can definitely support the stock. Any declines that are contained in that region are seen as limited corrections and can lead to can help lead another leg higher. And with that said, let's go to Nasdaq. We're still a minute out over the US Open. It slides today after one of its worst weeks of the year, partly due to the Apple slump, which weighed on the tech-heavy index, and of course the uncertainty around the Fed's next step ahead of the CPI inflation update on Thursday. It tests again the MA 200, which makes it vulnerable to the 15,900 and the top up border of the daily Ichimoku cloud, but the strong catalyst we needed for deeper corrections that would test the lower range and the ascending trend line from this year's lows located here at around a little above 14,000. The 2023 rally has been largely fueled by the AI boom, and it's hard to be undermined by the Fed. So pullbacks here are reasonable, but at this stage we view them as necessary for the advance to continue to new 2023 highs. Of course, we're going to have to see the incoming data and of course what the Fed will do. And let's round things off with what's ahead. China PPI and CPI on Wednesday. The world's second largest economy is grappling with inflation as factory gate prices are in negative territory for almost a year, and consumer inflation printed at 0% in the previous month, showing that consumers are keeping their purses tight. These figures highlight concerns around the recovery. So the latest update will be significant, not only for Chinese assets, but also for oil, copper, and other products, and of course the broader mood around global financial markets. And then on Thursday, we have US CPI inflation update. It has been coming down in the United States, and the headline CPI had decelerated sharply to 3% in June. Given the progress and the lag in the transmission mechanism, the Fed may have already done enough. On the other hand, it may be hard to stop given the tight labor market and resilient economy. Given the above, the Fed did not offer any forward guidance and touted data dependency, so the release will be a critical piece to the policy path puzzle. And of course, we are deep in the earnings season. We expect EV startup Rivian tonight. I will be focusing closely on it. As most startups, it has struggled in the unfavorable environment of the previous year and into the current, which of course improves, but the firm's nearly tripled its deliveries and production compared to a year ago in the second quarter. So we will be looking at how the rest of the data come in. And of course, this week's main event is Disney, the entertainment giant. We already had a Paramount overnight, and last week we had Warner Bros. Now Disney is in a rough patch, as most of legacy media companies, as the linear TV suffers, and Disney's streaming services lost subscribers in the last 2 quarters, while its latest movies have not performed very well at the box office. However, the financial of the streaming business actually improved in the previous quarter, despite a recent price hike, which shows that Disney has pricing power. And of course, there is also a restructuring plan underway, which includes cost cuts, so progress on that will be also closely watched. So that's pretty much it for me for today. We'll talk again on Thursday at our usual time, 10 minutes before Wall Street opens. Thank you for joining me.